dirt road in a gooseneck, saddle up with me. Dry land in God's country, crops far as I can see. The headlights on both ends of my day. This country life is for me. Ride with us, HPJ. Ride with us, HPJ.
Well, good afternoon, everyone. I'm Jennifer Latsky, and I'm the Associate Editor for High Plains Journal, and this is our noon session of High Plains Journal's Virtual Cattle U. The session we will hear from Roger McEowen and Logan Hoffman about the finance side of your cattle businesses. You know, we all know that the office work is the least exciting thing that we do on a cattle operation. But time spent in the office chair or at the kitchen table planning for your family's business's future is just as vital as time spent in the saddle. Making sure you have the tools to keep your family business financially viable for generations to come is part of why High Plains Journal started hosting these educational events a decade ago. Last year was our first Cattle U, our attempt to bring education to all segments of the beef industry. Like all of you, we wish we could be conducting Cattle U in person this year, but safety has to come first. And so we and our very gracious and flexible speakers and sponsors have pivoted to this virtual platform. We're all looking forward to July 2021 when we can once again return to an in-person Cattle U, and we hope to see you all then. But for today, let's go over a few things. First, we've already muted your video and microphones, but if you have questions, just click on the chat box at the bottom of your screen and type those questions in the pop-up box that appears to the side. We've built in plenty of time to ask our questions during the webinar. All of our sessions will be recorded, and the recordings will be posted soon after we're done on cattleu.net. The schedule of sessions and speakers is posted there as well. And if you miss a session live, remember, you can always catch up with the recordings later at your convenience. We want to thank our sponsors for this webinar, Kauffman Seeds. Here's a message from Kauffman.
Kauffman Seeds is your full-service seed company carrying our Midland Genetics brand of high-yielding corn, soybeans, grain sorghums, and forages. All the latest technology traits, herbicide options are available.
Midland Genetics corn hybrids and soybean varieties, whether traded or non-GMO, are selected and tested to perform and give farmers in Kansas and Oklahoma the best results possible. We have many dealers throughout southern Kansas and into Oklahoma. Call Kauffman Seeds today for a dealer in your area.
We raise background cattle. We farm corn, wheat, milo, alfalfa, soybeans, and sunflowers. My sons are the fifth generation to farm on our present location. Ever since the boys were little, they've been involved with me helping on the farm. It's a privilege to have all three of them involved with the farm. My name is David Peterson, and I'm a farmer and a cattleman.
Again, we really appreciate all of our fine sponsors for our virtual Cattle U. You'll be hearing from many more throughout the series of sessions this week. You can also read more about all of their products and services in the digital program that will be emailed to all registrants. That's our way of bringing the trade show to you. Well, now let's bring to your screens Logan Hoffman to talk about record keeping and accounting for better ranch management. Logan Hoffman currently works in beef extension with Colorado State University, leading a ranch analysis program called TRAC, Total Ranch Analysis of Colorado. The program helps cattle producers sharpen their ranch management abilities through the lens of increasing profitability. Hoffman earned a bachelor's degree in business administration from Simpson University in Redding, California, and a master's degree in ag business from Kansas State University. His professional experiences includes working in the cattle, grain, and lending industries, as well as livestock and data analysis. Logan, welcome to the screen. The session's yours.
Well, thank you so much for having me. I'm going to attempt to share my screen here. I'm excited to talk about this topic in which I get to spend most every day. So although it may not be the most glamorous job on the ranch, I think it's really important, and I'm excited to kind of share with you guys on a little bit about what we do. See that. So as we mentioned before, the presentation topic today is really about record keeping and accounting for better ranch management purposes. And as we mentioned again, I'm Logan Hoffman. I work for Colorado State University, and we have a pretty unique program at Colorado State. And it was started about a year and a half ago or so, and it's called Total Ranch Analysis of Colorado. And we've been able to get around the state of Colorado, and we work with primarily cow-calf and seed stock producers and gather financial and production data and help them with analysis to become more profitable. And it's really been fun to see different operations and how they work. And really, I move to the next slide. There's a couple different benefits to this program. And what we see is number one, what we're doing is creating a benchmark database. And that has some benefit for sure, because we're able to aggregate these numbers and have ranchers look at their numbers compared to other producers in their areas to see where their strengths and weaknesses are. So that's definitely something that I think is valuable. But the real value, I think, comes, and this is what we're going to be talking about today, is when we calculate these numbers, how that can affect an individual ranching operation year over year. So once we see trending data, it can show us highlight, strengths and weaknesses, and we can make decisions based on those numbers. So if we're going to jump right in here, I have 3 goals for today's presentation, and hopefully at the end we can take some questions as well. But the first goal for the presentation today is understanding the different ranch centers. And on any given ranch, there's 3 different groups of centers that we talk about. One would be a profit center, one is cost centers, and the other is support centers. So we're going to define those later and talk through those. The second objective for today's presentation is we're going to walk through how to calculate an accurate and consistent unit cost of production number. And in the program that we do, we calculate all sorts of different key performance indicators. But I would say the most important number to calculate on any ranch would probably be the unit cost of production number of each enterprise. So we're going to spend some time looking at how to do that well. And then lastly, we're going to look at how to utilize, once we've calculated the unit cost of production number, we're going to look at how to utilize that to make management decisions and become more profitable. So let's talk a little bit first of all about why we keep records. What records do we keep? I know some people probably think they keep way too many records. Some think they keep too little. But generally, when we're talking about the ranching industry, we collect probably generally financial and production records, and we do so for a variety of different reasons. From a financial standpoint, accountants are looking for that financial data in order to submit and prepare taxes, which we all have to do. We also disseminate our financial information to lenders in order to get loans. From a production standpoint, veterinarians, of course, look at some of our production data, and then genetic data as well if we're talking about breed associations and registering animals and things like that. But if you think about that from a financial standpoint and a production standpoint, those different stakeholders who look at our data, they all have varied objectives or goals in which they're going to use that data. But not always do those objectives or goals align with what our goals should be in collecting the data. And really, as a producer, the goal should be collecting this data and utilizing it to make management decisions. And so that's what we're going to be talking about today. And we need to do that in order to have good data to make decisions off of. So let's talk about these different ranch centers. As I mentioned earlier, there's 3 categories of them. 1 would be profit centers, 2 cost centers, and 3 support centers. And really the big idea here is if we look at the ranch as one unit, it's really hard to identify areas of strengths and weaknesses. But if we break out the ranch into its critical components, then we can drill down and find and effectively manage those strengths and weaknesses. And so that's really the objective in breaking out the ranch into its different units. So let's spend a little bit of time defining these different ranch centers. The first category would be support centers, and support centers are the same on any given ranch, and really what they represent are overhead expenses. So all of your expenses that come into the ranch that are incurred are either going to be directly associated with a cost center, a profit center, but if they're not associated with one of those, they would go into this support center bucket. And within the support center bucket, there's 4 different support center expenses. There's general administrative expenses, labor and management, machinery and equipment, and then interest expenses. So again, those are the same on any given ranch, and the expenses that go into that category are ones that cannot be directly associated with a cost center or profit center enterprise. Okay. The second ranch center we talk about is our cost centers, and these can be defined by the ranch manager, and they can be really broad or narrow in scope, depending on what the manager decides. Cost centers can be as broad as grazing or as narrow as preconditioning or irrigation expenses. The key here is that we want to track these cost center expenses, but they do not realize revenue or much revenue. They're not revenue generating enterprises, they're just accumulating expenses. Profit centers, on the other hand, are revenue generating enterprises. They both accumulate expenses, but they also generate revenue during the fiscal year. And from a profit standpoint, they'll accumulate a net income, and that each profit center will accumulate a net income that will then be added to the total farm or ranch net income. Okay, so those are the different centers that we have to be clear and defining if we're going to calculate a unit cost of production. And along with that, we need to associate our expenses and our revenues with inventory numbers. So when we're calculating a unit cost of production, we need to, the goal would be to analyze each part of the ranch on a per unit basis. And the equation there it's a pretty simple equation, but it's the allocated amount of revenue expenses. Have to make sure to get that right, the allocated amount, and then divide that by the applicable inventory units. So there's 3 examples that I have here. If we're talking about hay costs, we want to isolate the hay costs that are, again, just associated with that enterprise, and we divide that by the ton that is harvested to get a hay cost per ton of hay. From a replacement heifer standpoint, we want to isolate those expenses and divide them by how many replacement heifers we're developing. And then from a cow-calf standpoint, we're looking at all the expenses related to the cow-calf enterprise divided by the amount of weaned calves we have, or pounds of weaned calf if we want to go down to that level. And so the accuracy depends on two things here in order to get this right. One is the correct amount of revenues and expenses that are associated with each of those buckets. And that's easier said than done. We're going to walk through on how to do that, but you have to get that right. And then of course you have to divide that by the correct amount of inventory units here. So I think the main goal here, or the main objective, would be that aggregate numbers don't mean much because you can't put them in context. In order to analyze something, you have to break it down on a per unit basis. So that we have to match those up in order to see where we're going. This is a little bit of a busy slide, but we're going to spend a decent amount of time looking at this. On the left side, we have a roadmap to calculate our unit cost of production and or break even. On the right side are the steps in order to do that. So we have visual depiction on the left, and then on the right is the written steps on how to do that. But before we do that, I want to distinguish two things here. This is a roadmap to calculate the unit cost of production and break even. So the unit cost of production is not the same as a break even. The difference being a break even takes into account expenses and revenues, while a unit cost of production number takes into account only expenses. And from a management perspective, if I was choosing to track one thing, I would rather track the unit cost of production, because from the revenue side of things, you have the volatility of the market from year to year, and you also have some miscellaneous revenues that are realized. Say it's a drought year and you receive a government payment this year but not next year, and so there's a lot of volatility there, and your break even is going to jump around a lot more than your cost of production. So if I'm a manager, I want to nail in that cost of production number because it's manageable, it's consistent. So let's look through this roadmap and kind of talk through the different steps. So before we even begin, like I mentioned before, the support centers are the same on any given ranch, and so it's those 4 up top. Then we drop down to cost centers, and those are defined by the manager. And then profit centers is the revenue generating enterprise we're analyzing. Okay, so the step one, the first thing we need to do is identify our operations profit centers and cost centers. And so in this operation, the managers decided, I want to isolate my grazing cost centers, and I want to isolate replacement heifer cost centers. I want to know how much it cost me to produce or develop a replacement heifer. And then also they produce hay, but it's not a revenue generating enterprise. They feed the hay to their cattle, their herds. So it's a cost center. And so those are the cost centers that this operation is defined. And then the profit center would be the cow-calf enterprise, because on this operation, they would wean a calf in the fall and sell them right at weaning. Okay, so once we've identified the operations profit centers and cost centers, the next step, step 2, would be to classify the income statement expenses and revenues if you're going to do the break even. But if we're only doing expenses, we need to classify those income statement expenses into one of 3 categories. So we take the financials and drop them into buckets, and they're either going to go directly to a cost center bucket or a profit center bucket. And if they're not directly associated with one of those cost centers or profit centers, then they'll go into the support centers because they're kind of unallocated in their overhead expenses. Okay, so that's step 2. Once we've completed step 2, all the expenses should be in one of those buckets, either in the support center overhead expenses, the cost centers that we've already defined, or the profit center. Now, step 3 is we need to figure out a way to allocate those support centers or those overhead costs, those 4 orange buckets up there. We need to figure out a way to allocate those expenses down into cost centers or profit centers. And we're going to talk about that on the next slide. That's a little bit difficult to do, but very, very important step. because if you don't allocate those expenses, then all your numbers are going to be skewed. And so we need to figure out a way to allocate those support centers. And now step 4, once all the expenses have been moved out of the overhead expenses into either a cost center or profit center, step 4 would be we need to transfer those cost centers into either other cost centers or the profit center being analyzed. Okay, so if you can kind of see the visual depiction on the roadmap, everything funnels down to the enterprise level, the profit center that's being analyzed. And so you take all of your expenses and they funnel into these buckets, and they're allocated and they're transferred. And eventually what we have, once we've done this correctly, is the appropriate amount of expenses associated with that enterprise at the cow-calf level, and that we can look and finally calculate our unit cost of production number. And so we would compare that appropriate amount of allocated expenses against the applicable inventory units, which in this case on a cow-calf level would be the total pounds of cow-calf. So now I know how much it's going to cost me to produce a pound of weaned calf, 100 weight of weaned calf, or just one weaned calf. So, but you can't do that unless you've properly vetted and funneled these expenses through these different measures. Okay, but in this example, we're looking at the cow-calf enterprise, but it can be any other enterprise that you want to calculate. And the process would be saying you're taking support centers and you're funneling them down into cost centers, funneling them down into profit centers to make sure we have selected the appropriate amount of expenses that we want to analyze. Okay, and so now we're going to go over 3 tips for calculating that unit cost of production number. We kind of walked through it visually and went through the steps. And these 3 tips come from kind of common issues that I see when I work with ranches on maybe things that they haven't thought about or that we haven't done as consistently, but something that we need to do. So the tip number 1 in calculating this accurate number, this unit cost of production number, is deciding on our non-cash expense methodology. And so oftentimes what we see when I ask a producer, how much does it cost to run a cow on your operation for a year? They'll give me a number, but what they're giving me is just only cash costs. Now there are 2 large non-cash costs that should be figured in when you're calculating a cost of production number like a cow cost. The first one would be management expenses, unpaid management expenses. A lot of folks do, but some folks don't pay themselves in order to ranch. And I guess the question there is, are you subsidizing your operation by your own labor? In other words, if you were to walk away from the ranch and pay somebody to do what you did to manage the ranch for you, is it viable? Is it economically viable? Could it stand alone as a business if you weren't subsidizing it with your labor? So that's ultimately what we're trying to get there. And so folks that don't associate a salary expense with their own labor, we go ahead and associate one for them so that they can use that salary to go and buy personal items like everybody has to on a day-to-day basis. Okay, and then the second one, which is really big and we could go into for a long time, is depreciation. In depreciation, the non-cash cost represents 20 to 30% of a total cow cost on any given ranch. And let's just give a very general description of what depreciation is, or a definition. And depreciation is the loss in value of an asset over the course of its useful life. So something that's going down in value over the course of its useful life. And herein lies the difference between management depreciation and tax depreciation. So with tax depreciation, I have a little note there. Section 179 for taxes allows you to write off up to 100% of a qualified expense that was incurred in 1 year. So if you do that, that will help you mitigate taxes, but it skews your cost of production for that year, right? Because it enlarges your unit cost of production number for that year because you wrote all that depreciation off in the first year, and then the coinciding years, the next year, the year after that, the year after that, that cost of production number is going to look lower than what it should be because the value is not strung out over the course of its useful life. The other aspect with tax depreciation that's different is that taxes only require you to depreciate purchased assets. But my question there is, what about raised breeding herds? So for tax purposes, if you purchase a bull or purchase a breeding cow or a heifer, you would depreciate her because you purchased it. But even if you raised your own bulls or raised your own cows, they still go down in value. They're not going to be in your herd forever, and they need to be replaced at some point. So from a management side of things, you still want to budget in a depreciation for raised livestock because you're going to have to take that money and reinvest it into your herd in order to develop bulls and females going forward. So we would recommend, and what we do with our producers is recommend budgeting depreciation using a management method or a straight line method, basically taking the total cost of the asset or how much it costs for you to produce it, and then a salvage value at the end, and then stepping that evenly over the course of its useful life, or the decrease of value over its useful life. So that's the tip number one, is developing that non-cash expense methodology. The next one that I want to talk about is developing an allocation scheme for overheads. This is what we talked about on a couple previous slides when we're talking about every ranch has support centers. They have 4 different support centers, and we need to figure out where they ultimately go. Where do they go in the enterprise level? Because this is a big deal, and overheads can represent 55 to 65% of total expenses on any given ranch. So it's pretty important that we make sure to take those 55 to 65% of expenses and put them in the right bucket. And you can do this a couple of different ways, but the key here is staying consistent no matter what you do year after year. Because if you allocate those expenses differently one year versus the next, then even though your production may stay the same, one of your enterprises is going to look good one year and it's going to look poorly the next year, just because you pushed a pencil in a different way and allocated those expenses to that enterprise in a different way. So whatever you do, make it consistent. And I want to show you what we do at when we're looking at overheads and how we go about doing it at CSU. So hopefully you can all see the Excel sheet that I have right now pulled up. And holler at me, somebody holler at me if you can't, but I'll just go ahead and assuming that you can. How we allocate overhead is develop an AUM schedule. This is pretty easy to do. First of all, we list on the left-hand side, this is just an Excel sheet, all the different livestock classes on a given ranch. And once we have the livestock classes listed, then we go ahead and assign them an average AUM equivalent. Basically, it's their average weight throughout the year. So a mature cow on this ranch, this is an example, would be 1,300 pounds. The bull on their ranch would be 1,700 pounds. The heifers, 1,000. The next heifer class, 800, and so on and so forth. And once we have the weights and the classes, we go ahead and by month assess how many were in our possession of that livestock class throughout the year. And so once we have those 3 pieces of information, we can calculate the AUM per livestock class. So I'm going to scoot over here and show you, this is the percentage of AUMs of each livestock class on the ranch. So in this instance, this operation has a stocker operation. They purchase yearlings, and those yearlings account for 14.4% of the total AUMs on that ranch in a given year. So coincidentally, if I can talk, they'll get 14.4% of the overheads expensed to that enterprise. Okay, and the same thing with the 2017 replacement heifers. That's a cost center that this ranch wants to analyze. They had 10.9% of the AUMs, so they're going to receive 10.9% of the overhead expenses. And then the next heifer class, the 2018 born replacement heifers, is a different cost center. They get 8.6% of the overheads. So that's the way that we do it at CSU. It's consistent from year to year. We allocate the overheads that way. Is it the right way for you? Maybe, maybe not, but it's consistent. And that's the key thing is having consistency no matter what we're doing. So let me go ahead and jump to the slide that we left off at. That was tip number 2 and how to effectively allocate those. Tip number 3 in calculating an accurate cost of production number is categorizing the expenses on the front end. And so it is far more accurate to assign transactions when you're entering them into your accounting system versus estimating them at the end of the year. And these are made up numbers down below, but this would be a pretty accurate, income statement, what an income statement looks with the ranches that I work with. And as you can see, there's all sorts of scribbles all over. We're taking out personal expenses. We're estimating that 40% of this goes to hay, 950 of that goes to the yearling enterprise. Well, maybe 25% hay goes there. The key thing here is, yes, you can do this at the end of the year and go through and try to add percentages into those different buckets to try to get as accurate as possible, but it's only going to be as good as your best guess versus if you're entering transactions at the beginning level when you go to the feed store and purchase something and you assign that transaction to a different profit center, cost center, whatever it is, livestock class. So you can actually tag that expense on the front end versus having to go on the back end and try to estimate these percentages. Either way works, but it's a lot more accurate. It can only be as accurate as you can estimate it on the end versus it will be 100% accurate if you put it on the front end. Okay, and I wanted to put this in quick, and I know we're running a little low on time. If you are interested in trying to look up ways to reduce your unit cost of production, there's a great article and podcast by a friend of mine, Aaron Berger, out of the University of Nebraska. It's like a 20-minute podcast, and I think it's called 5 Ways to Reduce Your Unit Cost of Production. And those are the listed 5 ways right there. I'm not going to go into it right now, but it's really interesting as he talks about what you need to do on the cost side, what you need to do on the production side, 5 different ways to reduce your cost of production. And then there's 2 ways I have listed. This is the first of them. Once we have calculated an accurate unit cost of production, how to use that number to become more profitable, become better ranch managers. The first one is, I like this word, judicious budget management. So if I'm doing this year over year and I'm putting in and allocating my expenses the same way year over year, if I'm putting them in my accounting system the same way year over year, then I can find my line items here and calculate trends on my cow cost or whatever cost of production number you're analyzing and try to figure out which items are going up a little bit, which ones are going down. And then that'll kind of make you question, why is depreciation rising this way? How do I get it down to a manageable level? Why is my custom hire number up? Why are my utilities up? Why are my utilities down? What are my rents and leases doing? But you can't look at these numbers objectively if you don't do it accurately year over year over year and ask yourself those questions and make decisions based on those. So it's important to get the calculations and the allocations correct so that you can look at these and actually make a decision based out of this number. And just for your reference, these are the line items that we use on all of our given ranches. And I've rounded some up to the $5, rounded some down to the $5. But basically, this is about what we see an average cow cost for the ranches that we work with. Now, we're including depreciation, and we're including unpaid, those two non-cash costs, depreciation and unpaid labor and management. But it's about $1,000 to run a cow is what we've seen. And that's pretty consistent as I look across some of the different universities and different consulting firms that we work with. So that number may be alarming, but that's pretty accurate. And so just for your own reference. And let's go to the last slide here. Ultimately, in addition to judicious budget management, how we use a unit cost of production to become more profitable is we're basically doing enterprise opportunity cost. Framing this, we're looking at raising versus buying decisions, or adding or eliminating enterprises. So if I know how much it costs me to produce a ton of hay year over year, I'm going to be able to decide whether I should continue to raise or should I buy that hay. If I know how much it costs me to raise a replacement heifer year over year, I'm going to be able to make that decision a lot more in an educated manner, whether I should raise my own replacements or purchase replacements. The same with, the cow-calf level. If it costs me year over year, this amount of money to raise 100 weight of weaned calf, maybe that cost is too high to stay in the cow-calf business. Maybe I need to utilize my resources elsewhere in a stocker operation or something else in order to actually have a economically viable cattle enterprise. But again, these numbers, if I'm asking myself raise versus buy decisions, am I adding an enterprise or should I get rid of an enterprise? It's very difficult to make those decisions without accurate and consistent numbers year over year. And so the questions that we have to ask once we've calculated that are these economically viable enterprises for my operation? And then two, what other kind of non-financial factors need to be considered? And the biggest thing there, when I think about non-financial factors, would be maybe from a replacement heifer standpoint. If it costs me consistently maybe $150 or $200 more to raise my own replacement heifers than I could go to the sale barn and buy one, is that worth it? Because they're already acclimated to my environment, they're adapted to my environment, I don't have to keep bringing in outside cattle into my herd. Is that $150 or whatever worth it? But again, maybe $150 is worth it, but is $500 more worth it? It's hard to tell. It's hard to make that decision without numbers to go along with that. So hopefully you all got a little bit of insight into the unit cost of production number, why that's so important, how we can use that number. Happy to take questions if anybody has any, but thanks again for having me.
Well, hey, thank you for sharing that, Logan. I tell you what, I first encountered this methodology through Stan Beavers at Texas A&M AgriLife Extension. I know it's made a lot of Texas cattlemen rethink their own operations, and I hear it's doing the same for many in Colorado too. Folks, remember, if you've got questions, now's your time. We have Q&A with Logan, and if you want to, you can click on the chat button at the bottom of your screen, and it'll appear a box to the side, and you just type your questions in there. You can ask them to the group, or you can direct them to me specifically if you want to ask them confidentially, because I understand not everybody likes to raise their hand in the group. Logan, while we're waiting on some questions from the group, I had some thoughts that came up, and you and I, when we were talking about bringing you on to Cattle U, we talked about a lot of these things, but the number one thing that really struck me is because we can gather our actual cost of production and what those enterprises cost us and what we may be passing up. This sounds like having these numbers can help us figure out how to bring the next generation into the ranching operation and in what form. Is that what you're hearing from people that you're working with?
Yeah, absolutely. I think, no matter what the end goal is, whether it's bringing on, folks to come in from the next generation or expanding with, hired workers, whatever it is, the opportunity to grow can only be realized if I like to look at it in two different ways. One, you're optimizing your current enterprise, right? You're making sure that is running as efficiently as possible. Your costs are where you need them to be. And then two, you need to figure out your right enterprise mix. And so if you go through and you can calculate and figure out which enterprises are your weaknesses, which are your strengths, and then where are your opportunities to maybe even bring on an enterprise, you have to do that. But in order to do that, you have to be able to calculate these in an accurate manner. So, I've heard a lot of ranches talk about, well, if somebody's going to come back on the operation, they need to bring an enterprise with them, bring something to add value to the operation. But I guess I would challenge that and say, yeah, absolutely right. But before that even happens, you need to figure out, of the enterprises that are on your ranch currently, is there any dead weight? Because if somebody's bringing on an enterprise and you have this dead weight hanging on with you that you've been doing for years and years, it's going to make that even more difficult for a new enterprise to be successful.
Not always doing the same thing the same way that the previous generations did. Sometimes we are actually, shooting ourselves in the foot because there are some costs to that, and we're not really opening our eyes. That brings to mind that you talk to a lot of ranchers. What was the aha moment or the time where they look at it in real life and go, holy cow, that's the light bulb right there. I've been doing this all wrong. Is there a specific thing that comes to mind?
Yeah, I think, I don't know if there's throughout this process, I don't know if there's a specific point in which folks are like, oh, I never thought about that, or I did this or did that. But I think what you said is accurate. Is, a lot of folks will ask, my banker tells me I need to raise my own replacement heifers, or I need to purchase my own replacement heifers, or a lot of folks will ask those raise versus buy decisions. And it's been like years and years that these folks have done. They've raised their own hay. I mean, that's because what they've done. They do what they do. So, it's not maybe necessarily an aha moment, but the aha moment comes after we calculate that number for consecutive years, and you can look back and say, really? Did it really cost me that much to produce a ton of hay or to develop my own replacement heifer? Man, I need to rethink that, because I can buy hay all day long at X amount of dollars or whatever. So the aha moment is not necessarily in the process, but it's afterwards, looking at the numbers and saying, man, if I've done that for 2 or 3 years now, it's about time to change some things, or, keep some things the same. And that can be almost as valuable as well. If you're proving with numbers that I'm in the right mix, I'm doing the right things, this is the best way I know how to make money in the cattle industry, good for you. Now let's figure out how to optimize it even more.
So that also brings to mind that having these numbers readily available when you go for financing, or when you're, talking about bringing on a partner to the operation or something along those lines, having these numbers available along with your accounting for your accountant and your tax purposes and all of that. It sounds like this would be something that a banker would look at and go, that fellow right there, or that lady right there, I want to, put in with them. I think they have it figured out.
Yeah, it adds value. It adds value, and it shows that you're diligent about and serious about your numbers. And like I said, kind of early in the presentation, accountants and bankers may have slightly different objectives than you have. And so keeping those, they say, keep 2 or 3 different types of books. Well, that's a lot of books to keep, but know in the back of your mind that, when you look at your Schedule F on your return, your profit and loss statement, that number is really hard to do anything with. It doesn't give you any feedback as to, which part of your business is doing well, which is not, or and then because of depreciation and some of the tax issues with with calculating these, it's slightly different. So if you can utilize those records to the best of your ability to make decision making, that'll only add value to when you go in for a loan or something like that, and show them that I'm really on top of this and I have what it takes to pay back this operating note or whatever.
Folks, remember, you've got Logan here for a little bit. One more question from myself, and if we don't hear from anybody else, we'll go ahead and let you go. But when somebody's wanting to set up this type of system, where can they go? We're so used to hiring out a consultant for a few things, and if they don't feel comfortable setting it up themselves, are there people that they can consult? Can that accountant help them with this, or their banker, or even extension? Where can they go to have somebody help them set this thing up?
Yeah, I think depending on what state you live in, extension is really a good resource. Nebraska puts on a great unit cost of production workshop, and they're really strong on that. Kansas State has, with the Farm Management Association through Kansas, that has really good extension. But I would just do some more researching online, looking up unit cost of production, because it's something that can be done if you don't want to hire out a consultant. Certainly your banker can help you, your accountant, but if you want to do it yourself, it's just understanding the methodology, because you already have the numbers, and it's just figuring out how to work those numbers. And so if you just get online, read some articles, extension websites are good places to start with. You can reach out to me and I can help you, put you in contact with some, resources as well. But it's very important. It's so important. And so I would start there. And if somebody's up for the challenge, this is the idea of working on the business versus, working, just going to move cattle around or whatever, which is so important. And this is way less maybe fun, but it's so important to try to get this type of work done.
So we do have some questions. Let's see here. One of our viewers wants to ask, can you list some benchmark resources? So some benchmarks that if you can tell if your ranch is doing the same as your neighbor, the county over, or in the same county.
Yeah. So from what I'm aware of in the kind of the Midwest, it's somewhat of a novel concept. Kansas Farm Management Association has great benchmark numbers, but they incorporate farming and ranching, farming and cattle into the same type of numbers. So it's really interesting when you're looking at cow costs or different costs associated with cattle specifically. Those are going to look a little bit different from a cattle operation that is specifically cattle versus a farming operation that uses cattle to harvest their products. So the cost associations are a little bit different, but Kansas Farm Management Association has a good database. The North Dakota State CHAPS, CHAPS, has a great benchmark data from a production level. And then what you mentioned earlier, Stan Beavers had worked on stuff like this for a long time in the Texas-Oklahoma standpoint. It's called SPA. And he's no longer doing it, but he does it as a consultant. And we're picking that up and doing it in Colorado. We are hoping to develop the benchmark database and be able to apply it regionally, because as you can imagine, producers who operate in the mountains of the Rocky Mountains are going to have a lot more input feed cost, probably, because there's barely it snows forever, versus like the plains of Colorado. So we're trying to develop that regional database, but I would kind of point you in the direction of the old SPA data out of Texas A&M, Kansas Farm Management Association, and then the CHAPS data, and then hopefully us once we get more data as well at Colorado State University.
Okay. We've got a question. Is there a booklet to help categorize these financial features? Is that what you and your team are going to be working on, is creating that booklet resource along with the benchmarks?
Yeah, we're creating different resources to help. Yeah, that's a good question. I don't know off the top of my head if there is a resource category. I'm trying to think. Now, yeah, I'm racking my head. I printed off the Farm Financial Standards Council. This is getting a little bit off of cattle specific, but if we're talking about profit centers, cost centers, allocation type things like that, the Farm Financial Standards Council is a good resource as well. And they have some books and some booklets, but it's pretty heavy reading, to be honest. There's not a whole lot of this is a need, I think, in the cattle industry. There's not a whole lot of resource available. So we haven't put together a booklet yet to categorize those expenses. We need to, but yeah, I don't know if I can tell you exactly where you'd have to go.
Okay, we've got one more. What's the recommended amount of liability insurance that a cattle ranching operation should carry? And does that answer differ depending on the states that the ranch has cattle grazing in? Does the ranch's location itself matter?
Yeah, gosh, I just have to be honest and say that I'm not 100% sure on that, and that's a great question. I would probably have to, if you talk to somebody from the insurance side of things, they would know a little bit better. Although they'd probably be trying to sell you something, so that might be a little bit of a conflict of interest. I don't know off the top of my head. I'm sorry. That's a great question, and I'm sure it would depend on different portions of the where you're actually operating based on the resources available, the drought, monitor forecasts, all these different things. And so, yeah, I wouldn't know exactly how to answer that, so I'm sorry. Good question, though.
Okay. Well, folks, it doesn't look like we've got any more coming in. Logan, thank you again for sharing all of that today and for answering all of our questions. Before we move on to Roger McEowen's presentation, let's take a moment to thank AgRisk Advisors for sponsoring today's session and with this sponsored video.
Howdy folks, Tate Berlier with AgRisk Advisors. When you listen to Dr. Peel's Market Outlook or Mr. Hoffman's presentation on managerial accounting, consider how you can turn that information into actionable goals for your operation. We'll miss seeing you in person this year, but the AgRisk Advisors team is always available to help you understand how to manage farm and ranch risk. Here's what some of our customers have had to say.
Happened this year that I found producers that still aren't aware that there's advantages out there for hedging some of that risk against Mother Nature being so volatile and the markets. They can literally track the last 10 or more years of what's happened in your grid area on your property. So you're not going into it blind, you're going into it with a lot of data that tells you this is what's been happening. Here's what we can do going forward.
Well, we pretty well know when Aaron's coming because a blueberry pie magically appears on the kitchen table. My name is Ryan Noble. We're in Yuma, Colorado, out on the Eastern Plains. Aaron does a great job. He's there for me. He's gonna get the job done. Last year we were concerned. We were having a dry year. Aaron jumped in a vehicle and here he came. He was here in about 3 days. That's pretty big to us.
My name is David Mendenhall and my family operation is here in Rocky Ford, Colorado. The AgRisk Advisors, my expectations have been met full-fold. They've met and answered every question I've asked.
The transparency and availability of Aaron and all the guys there now. If I have a question, it's usually answered within a little bit. My name is Marty Boehringer. I'm one of the managers and owners of Lynn's Family Farms. One less thing that we don't have to worry about when it comes to crop insurance. I have 100% faith in what Aaron recommends. Where Aaron, every year he comes out and we walk through everything and what the different options are. The time commitment that took doesn't go unnoticed.
And we also want to thank our session sponsors, Kauffman Seeds and American AgCredit. American AgCredit is sponsoring Roger McEowen's presentation this morning, and we have a message from them as well.
We raise background cattle. We farm corn, wheat, milo, alfalfa, soybeans, and sunflowers. My sons are the 5th generation to farm on our present location. Ever since the boys were little, they've been involved with me helping on the farm. And it's a privilege to have all 3 of them involved with the farm. My name is David Peterson, and I'm a farmer and a cattleman.
Kauffman Seeds is your full-service seed company, offering one of the most complete seed wheat lineups in the state, including varieties from Kansas Wheat Alliance, Oklahoma Genetics, Lima Grains Cereal Seeds, and Syngenta's AgriPro.
If you're looking for the yield leaders, check our lineup. We are sure to have varieties to fit your fields. Treatment with fungicides and insecticides are available. We have many dealers throughout southern Kansas and into Oklahoma selling bulk, totes, and bagged. So call Kauffman Seeds today for the dealer in your area.
Again, thank you to our great sponsors. And folks, don't forget, you can find more information about all of their products and services in the digital program that was emailed to you after your registration. It's our way of bringing the trade show to your tables. Well, now it's time to bring on one. Roger is a professor of cultural law and taxation at Washburn University School of Law. McEowen also teaches an undergraduate course in ag law at Kansas State University. And folks, he really did the textbook on agricultural law. You all probably have seen Ron many seminars he conducts annually across the United States for farmers, ag business professionals, lawyers, and other tax professionals. You've also likely heard him over 2 radio programs, each airing twice monthly across the Midwest and on the World Wide Web. He can also be seen as a weekly guest on RFD TV, where he discusses various ag law and tax topics with RFD TV hosts. Roger, the screen is yours, sir.
Thank you to American AgCredit for the sponsorship, as well as Kauffman Seeds. Really appreciate that. And I want to thank Logan Hoffman for switching a little bit with me here. I had my dates wrong. I thought I was going to be on tomorrow at noon. And fortunately, I had the time slot available. I literally had finished with the California Society of CPAs this morning. And I'll transition into another one after this presentation. So fortunately, I had the time available and can fit this in. I don't think in doing this almost 30 years, I've never managed to do that before and get my date wrong. I'm always fearful that I'm going to end up in the wrong spot at the wrong time and catch myself coming and going. And this is about as close as I've done that. So Logan, I appreciate you moving up so that I could gather myself and get the slides put together and ready to present today instead of tomorrow. So it is a pleasure to be with you. I want to give you my contact information. If I can get the slides to move here, there we go. There's my email address at the law school. I would give you the phone number, but given what's been going on since March and my travel schedule anyway, I'm hardly ever at my desk. And I don't teach on campus in the fall semester this year, thank goodness, because of all the requirements that they're having faculty go through. But I do normally travel coast to coast. A lot of that has moved to online, although in certain parts of the country I did start in-person meetings back in June. There's my website address. On that website, on the homepage, as you scroll down the left side, you will find a link to my blog on the Law Professors Blog Network. It's an agricultural law and taxation blog. And about 130 times a year, I produce a rather detailed article of roughly 2,000 words. It'll vary a bit, but that would be a good average, full of citations. It's fully annotated. For the practitioners that might be listening, it's linked to case text. So if I cite a case, if I cite a code section, you subscribe to case text, you can go immediately to that citation and read what I'm referring to. I'm also on Twitter. I use Twitter to convey educational information as well as Facebook. It's purely educational information. I don't bore you with anything personal. In fact, I couldn't believe when I first heard something about Facebook was out there, and I was puzzled, and why would that appeal to anybody? Who cares what I'm doing or what I'm having for supper or who I visited? But if they're going to give me a free platform to advertise what I'm doing, you better believe I'll take it. I can't believe, in my mind, that somebody was that stupid to do that. But apparently, it's worked out well for the owners of Facebook, and people like to share their personal things. I share educational things by Facebook as well as Twitter. So those are some resources that you have. There's a lot of material available for you on my website. The law school does a good job of capturing the podcasts of radio programs as well as the video from television that I do. I have a YouTube channel also that you can access on my website. So just a bunch of resources for you. And I'm in the process of starting to create a whole host of educational videos that will be available for purchase from the website. So there'll be literally, once I get rolling, there will be dozens upon dozens of these, and those will be at a low cost option for you. And we're trying to figure out the way that we want to present those in terms of how they can be purchased and acquired for you. Jennifer mentioned my books. Yes, there's information about those on the website. Also, West Publishing Company just contacted me to do another one. So we'll see when we can fit that in. But my seminar schedule is also on the website, so you can find that information there too. I also want to point out to you that the law school, we're really unique in terms of what we can offer students that relate to agricultural law. And there's no other law school in the country like this. This is the list of ag-related courses that our students can take at the law school. And I'm one of about 3 persons that teach these. These aren't available every semester, but over the course of 3 years of law school, a student can take as many of these as they can fit into their curriculum. And I teach some of these. I teach 3 courses every year, plus the one at K-State. And it'll rotate on the ones that I teach, but we're heavy on oil and gas and minerals, obviously, water law, agricultural law in general. And you can see ag taxes in there. I do all the tax. So if you see tax, whether it's oil and gas tax or farm and ranch tax, I handle the tax side of things and the estate planning side tied to agriculture. But what we're trying to address is the lack of well-trained attorneys in the rural areas, in the plain states, out west, and even in areas of the Midwest that are really underserved with well-trained lawyers on agricultural topics. And often agricultural law and agricultural tax is law and tax by the exception. So there are special rules that an attorney has to be specifically trained on to be able to represent farmers and ranchers competently. Well, let me get into the topic for today. We're talking about transitioning the farm ranch and succession planning in a really boiled down version. Now, I'll be in Montana next month, and I'll do an entire 8-hour seminar on what you're going to get in about a half hour. So that gives you an idea of the condensed nature of what I'm delivering to you today. But if you have the desire to keep your business in the family into the future, the question then becomes, what actions help facilitate a succession plan? What should you be thinking of? What things should you be doing to facilitate a transition of the business from one generation to the next, keeping it in the family? Well, let's just kind of cycle back and very quickly talk about the tax and legal landscape that you're operating under, because you have to operate within that regime, within that system. And where we're at right now is a result of what happened in 2012 that took effect starting in 2013, and then the 2017 Tax Act really kept the existing rules in place, but then made them even more favorable for farmers and ranchers. And what we have now is permanence, at least for a few more years through 2025, unless Congress changes it before then. Permanence in our estate and gift tax system. So what I mean by that is we know what the exemption level of the credit is going to be for next year for estate tax purposes as well as gift tax purposes. We know that that exemption from estate tax at the federal level has been indexed for inflation. We know that the estate and gift tax systems have been unified. So if you use some of your gift tax exclusion to offset taxable gifts during life, that will reduce the remaining estate tax exclusion at death. And that's what we mean by unification. And then we have portability. So if you don't have a large enough estate to use up the entire estate tax exemption at the time of death, then the amount that's unused carries over or is ported over to the surviving spouse to add to his or her existing exemption amount at the time of their death. And so those are the rules that are in place right now. And who knows what's going to happen? That all becomes political. You could see if we happen to have a sea change in the White House and the House and particularly the Senate, then you're going to see much less favorable rules. You can just look at the political platforms, and the current exemption that's well above 11.5 million would crash to somewhere between 3 and 5 million. And then estate tax becomes a much bigger issue for more and more farming and ranching operations. That's huge. But that's all based on what happens politically this fall in the elections. I don't think we'll see that. But of course, as attorneys, we have to advise clients that there's a possibility of that, and we have to have a plan in place in case that might happen, because our goals and objectives are subject to the whims of Congress sometimes. And that's unfortunate, but that's just the way it is. So we do have low transfer tax costs. What I mean by that is starting in 2013, the rate that applies to a taxable estate goes down or went down. We're now at 40%, which is still hefty, but that's better than it used to be. We have higher capital gain costs as a result of legislation in the prior administration that took capital gains from 15 to 20%. Then Obamacare added another 3.8% on top of the 20%. So on some capital gains, we went from 15% to 23.8%. Higher income tax rates prior to 2018, when Trump came in and cut the rates down for everybody, particularly the lower and middle income people. A new tax on passive income, which was part of Obamacare and has not been repealed. That's that additional 3.8% tax on passive sources of income. And we worry about that in the context of retirement and transitioning, because we often retire to passive types of leases. Well, if we do that, we have passive income. If we have sufficient amount of passive income, then it gets hit not only with income tax, but also with that additional tax on passive sources of income. We have greater disparity right now between the states, or among the states, between transfer taxes and income taxes. We have a number of states that don't have. The majority of states don't tax estates at death. If you're in Nebraska, they do. They have a county level inheritance tax. Iowa has an inheritance tax. But some states don't even have an income tax, such as Wyoming, such as Texas. Coming in will be Tennessee soon. South Dakota does not. So a lot of some of the major grazing states, livestock grazing states, don't have a state income tax. And so to the extent we can do some planning and shifting assets around, the use of trusts, we might be able to take advantage of those. But now, for just about everybody, income taxes play a much greater role than do estate taxes, because that exemption is currently sitting at $11.58 million per person. So if your taxable estate is under that, you don't have an estate tax issue, but you do have income tax issues. So when we think about cattle, you need to have a good ag CPA, ag accountant, ag attorney assisting you on putting your plan together, also from an income tax standpoint. And Logan's conversation earlier, what we do from a tax standpoint drives a lot of that. For our purchased cattle, are we going to depreciate them? Are we going to inventory them? What happens now, we don't trade personal assets, but we route a lot of that through what's known as a 4797. We're dropping out self-employment tax. That makes all types of issues. And so there that and other legal issues that we have to address in the scope and the context of a state business. But here's what happened under the Tax Cuts and Jobs Act, which was enacted in late December of 2017, takes effect generally for tax years beginning after 2017 and before 2026. Here's that estate and gift tax unified credit exemption at $11.58 million per person. So for a married couple, that's a little bit over $23 million. Now that's going to cover just about everybody, but I will tell you, I just finished dealing with a rancher's estate that was in excess of 30 million, and it was about 97% of that was land and cattle. And so there is an issue out there for some people in agriculture, but the distinct minority. That number, of course, is inflation adjusted through 2025. But again, if the political winds would change, the talk is that number drops to somewhere between 3 million and 5 million per person. And that's a game changer. That would be a game changer for a lot of people in ag. As I mentioned, only a few states that have an estate tax have an exemption that mirrors the federal exemption. That's a new point that I want to make here. Those that do have an estate tax do not have an 11.58 million exemption at the state level. So you could see an exemption anywhere from about, I think the lowest is about 1 million in the state of Massachusetts. The highest will be about 5 or 6 million, and the top rate at the state level, in addition to the federal estate tax rate, is in the state of Washington, and that's 20% at the state. So you'd face 40% federal, 20% state, so there's 60% right there. And 5 states do have this antiquated inheritance tax. Connecticut also has a gift tax. So just, I guess if you're ever on Jeopardy and those questions come up, you can maybe if that's Final Jeopardy and you win it, what's the only state that has a gift tax? You'll know that it's Connecticut, and please remember me as you collect your winnings. So what we want to do is we want to focus estate planning these days. We want to think about what our life expectancies are. Do we have any health issues that are going to shorten that? What's our lifestyle? Long-term healthcare needs. We don't want to overlook that. What if we would need assistance in a long-term care facility such as a nursing home? What's the cost of that over the course of a year on a monthly basis? Do we have liquid funds? Do we have monthly income coming in that can cover that bill? And so what can we do from a planning standpoint to put a backstop in place so that that's covered and we don't have to sell excess livestock off, we don't have to sell land off, those types of things to come up with the funds to pay a long-term healthcare bill. What's the size of our potential growth state? What are the type of assets that we own? Will they appreciate in value? This can be an issue for someone, for example, that has land in eastern Colorado, and the urban areas are encroaching upon the land, and it's putting upward price pressure on the farm or the ranch land. It's been a big issue, particularly in that area in the past. We get into water rights issues, the demand for water. If you have a water right, that is valuable. And the increasing demand for water in the West is going to continue to push up that value. So as attorneys, as planners, as we look at these things, we want to keep in mind all of those, and we want to try to draw those out of clients so that we have a complete picture of what your needs are. And remember that when you're sitting down with your estate planning team, to be thorough in explaining these types of your personal situation to them. Preserving eligibility for special use valuation, that's a technique in the tax code that allows us to value that ranch land in the estate at its ag value rather than at its fair market value. Will a basis increase be essential or beneficial? And that's really, that point right there, we could spend the next 2 or 3 hours on, because that is really the key for just about everybody in agriculture as well as elsewhere when we do estate planning and transition planning. And the point here is, if you own property at death and it's included in your estate for tax purposes, the heirs get a new basis in that property equal to the value of that property at the date of your death. And then if they were to sell it, they would incur less or perhaps no capital gain tax. So we always now want to think about that basis increase and the ability to use that basis increase. That's much more important for the vast majority of people than is avoiding federal estate tax. Again, the state of domicile at death, and whether we have a state income tax, whether we have transfer taxes at death at the state level. But basically the focus is on, all right, how do we transition this business to the next generation? What are the key issues? Do I need more than one entity? Do I need a land holding entity? Do I need an entity to run the operation and I tie them together for leasing purposes? What does that do to participation in government farm programs in terms of my payment limitations? That's an issue in ag that we have to worry about that we don't worry about with our non-ag clients. Do I need asset protection? Well, if you have livestock, you better believe it. And that insurance question is absolutely fundamental. My view on insurance is if you have cattle, you better have at least a base minimum $1 million liability policy that's going to cover incidences that can occur with cattle. What I'm talking about there is the horrible situation where a head of livestock gets out on a roadway and somebody hits it, and you've got a death that occurs. And so we get into fence law, we get into liability for livestock on a roadway. You want to talk about something that can screw up an estate plan or a transition plan really fast. That is not having adequate insurance to cover a liability event like that. Or make sure you are self-insured if you have livestock, as well as if you have employees. We want to know that if you have employees, because employees can be injured on the job. How are you going to pay for those things? So it's those tax and financial issues that will affect a future estate plan. You want to avoid the landmines. We can't always foresee the landmines. In fact, we can hardly ever see the landmines, but maybe there are things that we can do to backstop it a bit and put a plan in place to prevent those from totally disrupting the plan. And I would throw in even divorce in that, particularly if you have multi-generations in the farming or ranching operation, and there's a divorce somewhere down the line, and maybe the parents' generation is already working with son-in-law or daughter-in-law, and then they split up. Well, the child views the divorce as a personal matter. The parents' generation might view it as a business matter. Do we have a plan in place to deal with that possibility of occurring? So you want to kind of think negatively about, all right, what are the really disruptive things that could derail our transition, and then talk to your planners about what can be put in place to at least stop that from derailing the entire plan, and put a plan in place where you can still continue and carry out your goals. I'm going to skip over the coupling and portability issue in the interest of time, but basically what we want to do now is we don't want to make gifts during life. And I'm talking here gifting interest in the farming or ranching operation to the next generation. At least we don't want to do it from a tax standpoint, because to the extent we die owning those interests, then we're going to get the basis step up as we pass them on to the next generation. So that high level of the exemption really has that effect. It really discourages the use of taxable gifts. Now, some people may say, well, I do want to start transitioning ownership and management of the operation into the next generation's hands while I'm still around. And that's fine, but as long as we separate out what's going to happen from a tax standpoint, and you have an understanding that there won't be a basis step up on those gifted interests of land or interest in an entity into the next generation's hands, and you're comfortable with that, you understand the ramifications of that, I'd say that's fine. But this has to be considered as part of the overall business succession plan. Okay, but estate planners, and I've had to deal with this a lot since the start of 2013 in particular, and then 2017 when we saw, or 2018 when we saw doubling of the existing estate exclusion. A lot of people would say, well, I really don't need to see an estate planner because I don't have a tax issue. I don't have an estate tax issue is what they should say. You might have income tax issues, and you still have transition and succession planning issues. So you want to examine your existing plan, and you do want to talk to your planners. Do you have a plan in place, as I mentioned earlier, for asset protection? Do you have trusts in place? If that works in your situation, what about prenuptial agreements, postnuptial agreements, buy-sell agreements, handling business succession issues? Do you have that backstop in for long-term health care? What about financial and business powers of attorney? And make sure you review beneficiary designations on documents such as life insurance, pension plans, if that's the case, if you had an off-farm or off-ranch job, any type of asset that's not going to go through the estate, other than for tax purposes, because it has a beneficiary designation to it. Make sure that property has the correct beneficiary to make sure it gets to the correct person that you want to own it after you're gone. Those are just easy things we don't want to miss. We don't want to miss the obvious things. But we always want to compare the transfer tax cost with basis step up. There are some exceptions to that rule of the basis increase on property included in the estate at death, and that's what I'm talking about or pointing out on that slide there. But just from a practical planning standpoint, if you're under 11.58 million in taxable estate value, or that's for a single person, or 23.16 for a married couple, then the estate tax is irrelevant unless you are in a state that has a state level transfer tax at death. But we want to think about income tax basis planning. Income tax planning in general is very, very important. You don't want to forget that. You want to identify and eliminate common errors, asset protection planning, succession planning. Do you need a family entity? And then insurance again. Those are your basic considerations. Those are your starting blocks that you don't want to forget. Even though the exemption is so high, you may think that you don't have to do anything, or you don't need to. If you're in kind of this middle area between 1 and 2 times the current exemption equivalent of the unified credit, then we start to think about gifting, maybe the use of portability at the death of the first spouse, but we want to stick with our historic estate and business planning concepts. Then if you're in the group that's over 1 or 2 times the exemption equivalent of the credit given your marital status, then that's where we really work hard on succession planning and generation skipping, transfer tax planning, state of domicile of where we park assets, the use of trusts, and parking assets, I mean, other than land, by use of trust to take advantage of the state tax system that they have there. And then, of course, portability, using that to port over the unused exclusion at the death of the first spouse to the surviving spouse. There are questions that come up, of course, of what if Congress changes the rule at the time my spouse died, the exemption was, say, 12 million. Upon my death, what if it's 4 million? Are they going to, is IRS going to claw back any of that unpaid tax? Because now, at my death, the exemption is much lower. As of right now, the IRS says they will not do that. If that would come to fruition. But how do we bring in the next generation? These are the concerns that I've heard over the years, the most frequent concerns of people. Tell me how I can bring in the next generation. How do I make sure they have a base that's financially successful for the business into the future? And how do I exit? So we got to have an entrance plan, but at the same time, we have to have an exit plan for the current generation. And a lot of the older generation says, well, I want to make sure I'm fair for my on-farm and off-farm heirs. I've got that classic situation where I've got multiple children, some of which are interested, and I'm interested in having them run the operation in the next generation, but some of which are not. And I want to be fair to everybody. And often parents will say, well, I want to treat my kids equally. And I try to tell them that's not what you mean. You don't necessarily want to treat them equally. In fact, you can do great damage to a successful transition of your business if you slice everything up equally and divide the pie 4 ways or 5 ways or 6 ways, whatever the case might be. But we want to be fair. And that might mean a relatively equal amount of value in terms of control to on-farm heirs and dollars to off-farm heirs. Now, there are multiple ways to do that, and that's where succession planning comes in, and we try to minimize income tax at the same time we do all of that. And there are various ways to do that. And this is just some of that. We might have long-term acquisition of assets and control while the subsequent generation is supplementing with off-farm income, or they might have off-farm employment coupled with a rental arrangement, or there's a sharing of labor and capital. That can be beneficial from an income tax planning standpoint. But we always have to be wary with that strategy as to whether we're going to create a partnership, because that has some legal issues associated with it that we don't want to get into, particularly if there's a liability claim or there's a death and we're deemed to be in partnership. Those assets may not end up flowing the way that we want them to flow unless we have a formalized partnership agreement. But if we're just sharing labor and capital, often that's just an oral arrangement, and we can see IRS stick its nose in, or a creditor, and claim that you're in partnership, and then that's a game changer. So we got to be careful with those types of situations. Well, what type of entity works best? Moving quickly here, that's highly dependent on the facts. And the impact of the new tax law starting in 2018 may change that. We have a lower and a flat C corporate rate at 21%. We have a 20% pass-through deduction for non-C corporations. That's that qualified business income deduction if you're not a C corp. A lot of farmers can take that. So we're trading a 21% flat corporate rate down from basically 35 for a 20% pass-through deduction if you are not a C corporation. And then we have new individual rates and brackets. And those are lower than they used to be under prior law for just about every dollar of income through the all the way up the income ladder. But we'll see if that changes. Of course, we have candidate Biden out there saying that one of the things he's going to do, he says this almost every day, I'm going to repeal the Trump tax cuts. Well, if you understand, I have in a different presentation, I laid prior law where we were prior to those cuts over each other in a colored graph. Every single income range is better, all the way from 10% all the way to the top. Under the current law than under prior law, except for a little sliver around 290,000. There's a little gap in there where it's just slightly higher, just for $20,000 or $30,000 worth of income, and then everybody else is either even or lower than prior law. So if that's changed, then just about everybody can anticipate a tax increase. That affects our planning. And that's why I mentioned that, because we do pay attention to that on behalf of clients, because income tax planning and how taxes are a cost. It's a cost of doing business. And so we try to minimize that cost as best we can, using as many techniques as we can. You don't have to pay any more tax than you're legally obligated to. And so we try to use the best tax planning that we can. But the new law affects entity structure in various ways. Again, that's another topic in and of itself for another day. We also have to do Social Security planning. There's no limit on the Medicare portion of the tax, thanks to the Clinton administration in the early 90s. They took off the limit on the 2.9% portion of the 15.3. So as you go over the 137.7 of earnings, that's where the 12.4 drops off, and the 2.9 just keeps going. So there are things we can do from a Social Security tax planning that has to be part of the overall plan for the business operation. From a transferability standpoint, generally it's easier to transfer partnership interests and LLC interests and corporate interests than it is to transfer individual assets, because we're transferring interests in the entities rather than assets and the actual hard asset. And that makes it easier. So what I'm saying here, this kind of begs the notion that we need to have, particularly for our larger operations, some type of entity if we're looking at continuity into the next generation. It's just easier and it's smoother, and we can get tax issues, asset protection issues dealt with better than we can if we've got individual outright ownership and a sole proprietorship. So that's our comparison point there. Then, of course, we have to, as I mentioned, we have to worry about the FSA payment limitation rules. Starting with the 14 Farm Bill and continuing with the 18 Farm Bill, we've got a $900,000 limit for all our programs. That's based on a trailing 3-year average. So for 2020, it's based on 16, 17, and 18. After we skip 19, we average out the prior 3 years, skipping the immediate year prior to the current year. And if your AGI is over 900,000, you're not eligible to participate in the federal farm programs, with some exceptions. There is if you get 75% of your income or more comes from the farm, then under certain rules, the $900,000 limit drops out of there. But farmers now have a $125,000 limit per person. So I've got to be under the 900,000 AGI to be eligible for payment limits. And that is computed at the entity level first, and then to the owners of the entity up to 4 levels. Now, we often want our operating entity to be an entity that doesn't limit liability. So we're looking at partnerships, a general partnership, a joint venture, because if, let's say, there are 4 people in the general partnership and they meet the right-hand test, the left-hand test, and you've heard of those, the contributing land, labor, capital, and meet the rules, satisfy the rules, then they're potentially eligible as a person for a payment limit. So if I have 4, that would give me $500,000 worth of government payments. Now, if I'm a corporation as my entity and I have 4 people in the corporation, I get 1 payment limit at $125,000, which has to be split amongst the 4 people. So it's better to multiply those dollars instead of divide them. And that's all tied to how the entity is structured. Other programs, CRP has a $50,000 limit. EQIP and other conservation programs have various annual and total limits. It's incredibly complex. The FSA, the current rules are in what is known as the 5PL, or the 5 Payment Limitation Manual, and they issue changes on that all the time, and they never go through notice and comment procedure on that. USDA is notoriously bad about not putting their changes out for public notice and comment. They just do it, which irritates me. It irritates others in the profession that they do that, but that means we have to really stay on top of those things for clients. Here's how this works real quick. Let's say I have a general partnership farming operation. There are 4 owners. They each own 25%. And based on crop prices and the way they're receiving their subsidies, they're entitled to $500,000 in government payments. They would get 4 payment limits, and they would maximize out that $500,000 that they're potentially eligible for, with each owner taking their limit of $125,000, which corresponds to their 25% interest. Now, if you read on down that, if you look, if it's a C corporation, there you've got 1 payment limit because that's an entity that limits liability. You're stuck at 125. We're going to divide that by 4. Each person, instead of getting 125, gets 31,250. So again, we're dividing instead of multiplying, and that's not good. So you see on the bottom part of that chart, all of those entities, those 6 entities that limit liability, it also limits your ability to maximize your payment limits. So again, that influences the structure and the transition question when we're talking about clients. This is just another slide, kind of shows the same thing. This is attribution, showing percentage ownership and how we attribute payments to people based on percentage ownership in entities. So we want to, as we get into the issues of deciding our entity form, we want to talk about management structure, liability issues. Do we want to or can we pay fringe benefits? What are our costs on the back end of liquidating the entity? So our liquidation costs, ability to finance. Now, if we get into a situation where I've got confinement hogs, I've got confinement poultry, or maybe I'm operating a feedlot and I don't actually own some of the cattle that are in the feedlot, I can't pledge those animals that I'm raising in confinement that are placed there by an integrated firm. I can't pledge them as collateral. If I've got them in a feed yard, I run the feed yard, but I don't have ownership over the animals sufficient for me to pledge them as security for a loan, then that influences financing issues. And then, of course, the net investment income tax. So maybe we can make that go away. That's that additional 3.8% tax with the way we are structured. Do we want 1 or more entities? The multiple entity issue, let me just draw a diagram up for you. This is a significant tax court case back in 1995, came out of the state of Arkansas. Lee Mizell was the father. He had 3 sons. They were all farming together in their farming entity, which you can see at the bottom of the diagram. And that was a partnership. And Dad owned the land individually and rented it to the farming operation under a non-material participation crop share lease. So you see on the right-hand side, he has rental income that is coming back to him. On the other side, he gets a K-1 for his share of income from farming in the farming partnership. Now, if that were a different entity, that'd be a W-2 for his labor. So he's got labor income, he's got land income, he's participating as both the landlord and the tenant with respect to that land. And he didn't want to pay self-employment tax on that land. And often this is why a multiple entities setup is established, and that's the minimum self-employment tax. His argument is that rental income is not subject to SE tax because it's not an active lease. It's a non-material participation share lease. Now, his income attributable to his labor is subject to self-employment tax, but we're looking for ways to wipe out that 15.3% tax. IRS attacked him and said, no, your diagram was drawn incorrectly. We're going to combine your status as landlord and employee together under the code as the way we read it. And because you're both a landlord and a tenant, we're going to count all your income as being subject to self-employment tax. We're going to disregard what that lease says. And the tax court agreed with them. But a few years later, the Eighth Circuit said, no, as long as that lease represents a fair market rate of rent, then there is no gamesmanship of SE tax that's going on, and therefore you don't owe SE tax on passive lease income in that situation. We had some subsequent cases, the Johnson case, the Solvay case. If you're charging, if you're getting paid on a per head amount for your hog barn rent, then that is subject to self-employment tax. But if your rents are independent from salary and they are representative of a fair market rate of return, then that's within McNamara and you don't owe SE tax in that type of a multiple entity setup. And then Judge Paris in the tax court in 2017 in a case coming from Texas, the Martin case, the Chuck Martin case, said, I'm going to apply McNamara on a nationwide basis. And so if your lease is passive, and it represents a fair market rate of return, there is no self-employment tax in that multiple entity structure. And that's a big deal. If we can wipe out self-employment tax, that's very important to us. So make sure you don't have participation under the leases and make sure the rent doesn't exceed a market rate of rent. Equitably treating the heirs, a couple of very important points here. Don't involve the off-farm heirs in the day-to-day operation of the business under any circumstance. Just don't go there. Don't do that, period. Off-farm heirs should receive their inheritance by gift or as beneficiaries of life insurance, and avoid joint ownership of the real estate by the heirs. One of the worst things that you can do that'll blow up an operation from generation to generation is just leave the farmland in undivided co-equal interest to all the kids. You know, let's say you have 5 kids, and so Blackacre goes to the 5 kids as co-owners, and they each own an undivided 1/5 in the whole thing. Well, there's probably going to come a point in time where at least one of those kids wants to cash out. And then you're going to end up in a partition action. It's going to be a sale of the property, and the court's going to have to divide the sale proceeds amongst the heirs. And that's not a happy situation for those that were farm it or ranch it into the next generation. That's going to break it up pretty quickly. So we have to have mechanisms put into place as to how we get income and dollars into the hands of the off-farm heirs and control of assets and control of the daily decision-making in the hands of the on-farm heirs. So avoiding joint ownership post-death is a big deal. We can gift assets, we can rent assets, we can sell assets, or we can just hang on to them and leave them at the time of our death. Those are our 4 basic options for transferring assets to the next generation. What works best for you may not work best for somebody else. And so every situation is dependent on its own set of facts. Then when's the optimal time to set aside? I once received a call from an individual who was concerned. He wanted to take over the farming operation, and he said, Dad is having trouble deciding when to retire and turn things over to him. Can we come in and meet with you? And so I set a time where it worked for them, and they came in and met with me. I was stunned, literally stunned. Dad was 92. And still operating the farm, still running cattle. And the son was 71, and the farm had not transitioned into his hands. I can't imagine how he felt about that. But Dad just wasn't ready to retire. Well, what's the optimal time to retire from a Social Security planning standpoint? And what I'm getting at there is another thing to think about is there a time at which we retire where we can maximize the Social Security benefits so we can get as much back as possible from what has been paid in. And if we retire earlier, is there a way to minimize the reduction in the benefits? So that's part of overall profitability as we transition from one generation to the next. Is there an optimal time to retire? If it's your last year of farming, then we got to think about additional tax techniques as we transition into the next generation. And there, for people that don't necessarily have heirs, a charitable remainder trust may work pretty well because we can minimize income tax and eliminate SE tax and benefit a charity at the same time. But that buy-sell agreement is a very important document, probably next in line to a well-drafted will or a trust, because that's going to be the mechanism by which we extract often the off-farm heirs out of the business. And so you have to give careful thought to the events that will trigger the agreement, who has the right to buy the interest. You're thinking of death, you're thinking of dissolution of marriage, the big bombs that can really hurt a multi-generation operation, at least what the plan for a multi-generation operation. And then we have to think about how we're going to fund it. Often we use life insurance to fund buy-sell agreements, which is another point, probably for another day, as to how do we incorporate life insurance into this. And you mentioned life insurance to many farmers and ranchers, and they just don't want to go there. And yeah, that's true. A lot of farms and ranches don't have adequate level of life insurance, and they view the land as their life insurance, but you don't want to lose that land to buy somebody out. And we want to have that buy-sell agreement funded with something other than land, is what I'm saying here. And I kind of touched on the divorce issue already and the planning for long-term health care. How are we going to backstop that 5-year period when you make your application for Medicaid and before the government can pay? So, we want to get a fix on what our income items are, what are our liquid assets, do I have rental income coming in, do I have other types of retirement income that's there on a monthly basis, and then what is the difference between what the monthly cost of care is and what I have access to? That's what we have to plan for to backstop. So that requires quite a bit of work on behalf of the practitioner. It's a very specialized field of knowledge there, but that's something that we don't want to forget. We always want to keep that in mind. So we want to provide for a spouse and dependents, figure out who our key person is that we're going to transition the business to. And if we've got debt paid off, that's the best thing for a successful transition into the next generation and allowing them to have a profitable enterprise, is getting out of debt. And to the extent we've got no debt or minimal debt, we can do a lot more things from a planning standpoint to satisfy clients' goals and wishes. And how are we going to pay estate settlement costs? Well, that's only a concern if they're very large. The one that I just finished, as I was mentioning, a $30 million estate, that family's going to have to write a check to the federal government, even after all the planning, of about $6 to $7 million. So that's one of the biggest checks I've ever seen a client have to write, is a $6 million check to the Treasury of the United States. That's not something that's very fun to do. But they had a mechanism put in place, and they can make that check and they can pay it, and it's not going to damage the success of the operation. And that's the whole key point. Other big points: make sure you got enough income in your retirement years. You don't want to outlive your income stream. And then transferring leadership and management. Who are going to be the leaders? Who are going to be the managers? There is a difference between those 2 points. And make sure you're utilizing outside advisors. You've got to have, obviously, your attorney. It's the quarterback of the estate and business planning and transition planning team that's responsible for drafting the documents that's going to put everything in place. But you may have a farm manager, you may have an insurance person, you may have other people in extension that are helping you with various aspects of your operation. A good tax individual, CPA, or other tax professional that's key on ag issues. That forms your team. And you really, my view is, you want to work as a team and utilize those outside advisors. I know that's a real quick run through of a lot of stuff that we could have spent all day on. But Jennifer, I'll turn it back to you. Again, thank you for the invitation to be here today. Although I was planning on tomorrow, I'm glad we got that fixed. Good with you today, and thanks again for the sponsors.
Well, thank you, Roger. I tell you what, that's okay. We're in agriculture. We know how to roll with what happens. So these things happen. Folks, before, and thank you for sharing your time with us. I always learn something new whenever I get to sit in on a Roger McEowen presentation. So thank you. Folks, it's now time for Q&A. And because of the subject matter, I know that sometimes not everybody wants to ask those questions in public and everything. So if you want to, you can actually private message me, Jenny Latsky, or click on my name on the chat box. Ask me your questions and I'll pass them along to Roger here, okay? We do have a couple that came in while you were speaking. First off, how is AGI calculated? Do we use gross income or do we use the numbers from our tax returns?
Well, my answer to that is AGI for what purpose? Because it depends on the code section. Since I raised it once in the presentation, I'm going to presume that the question is AGI for purposes of eligibility for farm programs, the 900,000 amount. FSA is looking at the bottom line on the front side of the 1040. And if you're an individual, if you're an entity, it's the 1120 or the 1120S. And we'd had a problem because of that in prior years, because, and I think Logan got into this in his presentation just a little bit, that Schedule F number can be very misleading, because we can actually show a loss on a Schedule F, but have hundreds of thousands of dollars of income that probably is flowing through a 4797. So you can have a profitable operation that's showing a negative number on a Schedule F. Now, what FSA is concerned about is a bottom line number on the 1040, the front page of the 1040. We had an issue a number of years ago about expense method depreciation. And I might be able to use a bunch of expense method depreciation to drop my income below 900,000. And they were allowing that on for individuals, but not for other types of entities. And that has now been straightened out for about 2 crop growing seasons. And we had to go to court on that. And before we ended up in court, we showed up in court that day. And then we got the word as we were standing there that the National Office of FSA had backed off. So sometimes you got to push and get that taken care of. But again, and that's a screwy thing for lenders, because lenders can see, they'll look at, say, a Schedule F, saying, well, you're not making any money, I'm not going to loan you money. No. That's purely an accounting number. But AGI is a specific number, front page 1040 that FSA is looking at, or 1120 or 1120S or 1065, whatever your entity is. AGI, if that's not the question, AGI, I can't answer your question, because AGI depends on what code section we're worried about. And it's just a goofy thing. And IRS does that to us. Congress does that to us all the time. They define it one way for this, another way for this. You're a farmer for this, you're not a farmer for this. It's all over the board.
And that is why we have people like you that help us out to navigate that. We have another question from the chat sent to me privately. We have a question. Could we ask Roger to touch on the complexities of family farms in bankruptcy and the transfer of the estate to family? And particularly, we're talking about a family who's trying to purchase the farm during bankruptcy, not avoiding bankruptcy themselves.
So they're trying to purchase it out of the bankruptcy estate.
I believe so.
Can you tell from the question whether it's the same family, say the next generation of the debtor, or is it somebody unrelated to the debtor, or do we not know?
I can't tell if they are related to the debtor or not, but I'm going to go and assume that they probably are related to the. Ooh,
okay. That's going to be also.
They are related.
Okay. That's going to be an issue that, to a large extent, will first depend on state law, because state law, before you can even get to that point in some states, have a state mediation process that you have to go through when if we're talking purchase, what that implies is we're talking foreclosure and then sale at foreclosure coming out of the bankruptcy. Okay. If you're a creditor, an existing creditor, the creditors are going to have certain rights. Bankruptcy is going to establish a priority of pecking order of who gets paid. And then you've got to, the debtor has, in some states, has an absolute right to buy that property back for the first 6 months. This is known as the state redemption statute. So you have mediation on one hand, and then you have a redemption statute. Once you get past, usually, I'm talking generally here, and I did a blog article on this some time ago. Once you get past 6 months, then it opens it up for other creditors that can have a shot at that. But most states are going to take it to a year. So you're protected for a year, and that debtor has a right to acquire that property back by paying the full costs of the foreclosure, what it brought at foreclosure. So in other words, I could buy it at foreclosure, but if it's in bankruptcy, I may have to wait a year to get past the redemption rights of the debtor. Once that year passes, then I might actually get title. What I'm saying is you got to go through a state law governed process. And it's going to take time to acquire property and acquire title to property coming out of a bankruptcy estate. Let me just give you one. I wrote on this recently, and I think it's a horrible opinion coming out of the state of Iowa. I think it's flat out wrong. Foreclosure is to be an equitable remedy, which means be fair. What happened was a farmer was foreclosed on. He was in bankruptcy. He was at Chapter 12. He's foreclosed on. You get all the way through that. You go to the foreclosure sale. Property is sold. It's 2 tracts of land. Property is sold. Brings about $1.3 million. Okay, for these 2 tracts of land. Now, we're not talking about Western Kansas land. We're talking about very valuable $10,000 to $12,000 per acre Iowa farmland, good soil. So it's farmland. So it brings about $1.3 million. And the farmer's coming down, and under state law, he's got 365 days to come up with the money to buy it back, to redeem it back. He gets to day 364. He realizes he can't do it. He doesn't want the bank to get it because that's where it's going to go. The bank bought it at foreclosure and is sitting there waiting for the redemption period to expire. On the 364th day, he's got a farmer friend that he then transfers his redemption right. He assigns his redemption right over to his friend. His friend's got the money, and his friend can go to the courthouse. And this had been a prior, he had farmed the ground before. So he said, I want my buddy to get this because he's a farmer. I don't want the bank to get it. So on the 364th day, he assigns his redemption right to his buddy. The very next day, on the very last day, his buddy goes to the courthouse, goes to the clerk of court, and says, how much do I owe for these 2 tracts? And the clerk says, well, it's sold for $1.3 million at the foreclosure sale. And so he writes out a check for $1,300,000. The clerk gives him his receipt, says paid in full. Let me say, it actually said balance due 0. Means the same thing. 2 weeks later, the bank said, no, you didn't pay costs in addition to the $1.3 million, so your redemption's no good. We have title. Gets into the court system in Iowa, and the court said, yeah, that's right, bank has it. You got nothing, farmer. I think that's totally unfair. That's not right because the clerk in the court gave him an invoice that said 0 balance due. They didn't tell him that he had to fork over another $200,000 to cover costs and interest. Technically, that's right based on the statute. Foreclosure is to be an equitable remedy. That just flies in the face of everything that we've been taught as to how you handle foreclosure. But that's a long story to answer the question. You got to go through a process. And acquiring a property out of a bankruptcy foreclosure is going to take at least a year under most state laws because that debtor is going to have the right to redeem it. Those redemption statutes were put in coming out of the Great Depression and the farm foreclosures of the 1930s. There were additional backstops that were put in at that point in time, and those laws still exist.
Okay. You mentioned something about here when you were answering that question about whether it's family or outside the family. And here's something that's come up outside of Cattle U. We had, actually during Cattle U as well, we had it brought up yesterday during our marketing panel that we're not seeing a lot of new faces coming into the auction barns with cattle and everything. And one of the marketers and one of the auctioneers said, what can we do to bring younger people into raising cattle, into bringing them through our barns and such, and coming back to the communities? And one person had brought up, how are we passing along, not just within our families, but seeking younger people? If I'm of a generation that I want to pass something on, but I don't happen to have family by blood that wants to take this on, how do I actively seek a mentoring type of a partnership, or bring on somebody that I don't have blood kin, they aren't my blood kin, but I want to pass this on to them. How do we do that in a way that protects both entities, and how do we even get started with something like that?
Yeah, that's a great question. And that's, I hinted that we have that same problem in the legal profession of trying to refill some of these areas in the plain states in the West that don't have legal talent. I mean, we've got a generation, there isn't hardly 2 weeks that goes by where I don't get a call from an attorney that says, can you send me someone? I need to retire. I should have retired 4 or 5 years ago. I don't have anybody to turn my business over. Can you link me up with someone? Well, it's the same thing that you're talking about in this situation. Now, some states do have beginning farmer programs, and they do have these programs that are there where you can match. They're designed to try to match people that are interested in farming or ranching with existing people that are looking to retire. So have these systems, these programs that are in place to link them together. And so that's one place you want to go first, and there are various websites. That reminds me of silly, goofy commercials on whoever is the advertising agency for farmers.com should be shot and drawn and quartered, because those make agriculture look terrible in those ads. But it's kind of the principle that I'm talking about here. How do we match these people up? The one thing that would do it right away is if we had profitability in the ag sector. Obviously, if we had that, and that's more of a systemic issue that's out there, and I could talk about a lot of things concerning that, but if we have profitability, that's not a problem. One of the things that I tell our students at the law school is, look, there is profitability in a rural practice. You can go in and you can have an existing client base of several hundred clients, and if you know tax, you're gonna do quite well in a rural community. Plus, then you can be the big fish in the little pond. You're going to be representing a school board. They're going to want you on various foundations, so forth and so on. You're not going to get lost in a big city. And once that starts to click with some, and so I think one of these things in these match programs is that they really emphasize the benefits of living in a rural area. And given what's gone on, say the last 3 months in some of the urban cities in this country, boy, wouldn't a rural area look pretty good? I would think so. But you want to work what relationships that you have in the existing community, and ask around, ask people, look for those programs. I know K-State, through their mediation program, sometimes will be able to point you to these types of people. Various states have beginning farmer tax credit programs, and that can be beneficial if you already have somebody that has an interest. That provides you also a tax incentive to hook up with them. Now, that's a little bit different than a kind of a match program. That's where you have somebody that's interested in taking over. Doesn't have to be related to you. In fact, they're kind of designed that it's not somebody that's related to you. But you, as the exiting generation, can get nice tax credits for bringing someone else in. So you want to look for things like that. A number of states have beginning farmer tax programs. But I could go on and on, but I don't want to eat up all the time.
So this came up to us a couple of days ago when we had Danette Amstein, who was talking about some of the purchasing decisions that happened under COVID. And as you know, buying local just kind of bloomed during the pandemic. And we have a lot of our, the Shop Kansas Farms Facebook page just, boomed as people were trying to, source their meat. And so we have a lot of cattle producers that are actually selling out the door, packaged meats and things. What are one or two legal ramifications of that? How can they best protect themselves? Because now they really are going directly to the consumer. So what should they be concerned about?
Well, there are a number of things to unpack in that. And one, if we start doing on-farm processing, then we get some, from a tax standpoint, we get some non-tax activity on the farm and we have our farm activities. We have our farm or ranch activities. But once we start getting into processing, that's deemed to be a commercial activity for a lot of purposes of the tax code. And that changes some of the rules that are involved. And that can also filter down through the state and local level, because that may change your property tax issue if now you've got non-agricultural practices going on along with the agricultural practices. Is the county going to separate that out? You got permitting issues, all of that. So you do need to have good legal counsel when you change your operation structurally like that. But from an economic standpoint, the more you can capture the processing aspect of what you're doing, you're going to capture more of the consumer dollar of that. And I think that's what people are doing. And we're even seeing that, and I wrote an article on this, believe it was in July, on getting more value per acre out of your operation by changing the structure of the operation. And we're seeing that with some getting into exotic animals, you know, maybe captive deer farming is one, or an elk ranch. You know, you see the high fences that are around, and that's what they're doing. They have a certain acre where they raise the animals, and then they release them in these a larger part of the ranch where they're behind high fences, and they have people come in to hunt. Is that agriculture? Yeah, the tax code says that's still agriculture. And so but you can generate more dollars on less acreage than you can with traditional crop farming or livestock ranching. And we're seeing that, you know, the 2018 Farm Bill, it changed hemp from the classification of a controlled substance from marijuana, and now you have some farmers that become interested in raising hemp. Now, what I would tell you right now is don't do that, because there's no money in it right now. The ones that got into it early on did make some money, but the hemp growing activities, at least the Congress started to see that. And with pushes coming particularly from Kentucky, you got that delisted as a controlled substance. And that's another option for farmers that might be profitable down the road at some point. Now, in some states, the growing of marijuana is legal. I know in Colorado, for example, there are in that kind of that Weld County area. And you talk about Weld County, Colorado, they grow everything in Weld County. There's cattle, there's oil and gas, there's all types of veggies. It's like Napa Valley, California, in one county near Greeley, Colorado, and they've got marijuana plots that are out there. And those plots in all cash too, but that's a different story for a different day. But increasing profitability on smaller acreages, I think we'll see more of that. But when you start commercializing and getting into the processing aspect, you're going to capture more of the dollars, but then you have to worry about the other legal issues. And you just have to make sure that you button things down from a tax standpoint as well as a legal standpoint when you structurally change the operation like that.
Okay. So one last question. What's the hot or trending area of ag-related law and maybe general law today?
Well, the hot area on a downside is Chapter 12 bankruptcy. That is cycled back. You know, we saw that in the 80s. We see it a little bit differently over the past few years because interest rates are not killing farmers and ranchers, and land values haven't collapsed. So it's not the disaster that it was in the 1980s. But I will tell you, every single Chapter 12 case I have seen over the last 5 years is as a result of unnecessary debt that was acquired by the farmers. It's kind of, you know, when times were good, farmers and ranchers have the tendency to buy too much new stuff. And they've been encouraged in doing that, unfortunately, by the Congress and the tax code. You know, I'm going to buy this $500,000 combine, and I'm going to write the whole cost off. Well, that may not be the best thing you need to be doing right now. It may make sense from a tax standpoint, but it may not make sense overall. Buying too much land, paying too much for it, expanding too quickly, and then when the markets go out from underneath it, you're in trouble. I've seen that in every single situation that has crossed my desk. Dairy in particular. Dairy has taken it on chin real hard. So bankruptcy has been a big issue. Another one that's got to be hot, we have to keep our eyes on this, are right to farm laws. There is a right to farm law from Indiana that the U.S. Supreme Court is presently being asked to hear. They have not decided on it yet, but they will probably soon when they come back into session in October. It's going to be one of the first, I'd say within the first month, we will know whether they're going to take the case or not. And that's an issue that every state's got a right to farm law. So what the U.S. Supreme Court does, if they take the case, this is monumental. That will have ramifications for state legislatures and the way their right to farm laws read across the country. So that's an issue that's out there. Water law west of the 6th principal meridian is still huge and will continue to be huge as we get further west across the country and the scarcity of water. And then I would say those are 3 issues on a national standpoint. One of the issues that's, well, maybe on a regional standpoint, but although it's national, we still have a lot of litigation involving the cattle industry concerning the beef checkoff and labeling. Those issues are not going to go away, and they are still in the courts. We just had a decision about 10 days ago from New Mexico, where a federal district court in New Mexico had to issue an opinion involving mandatory cool. So those issues are not going to go away. And by the way, all of these things I'm talking about, I summarize these on my website too, so they're there. But I would say those kind of the 4 big issues that are out there in ag law and tax right now. And of course, Chapter 12 is big because as a farmer, you have the ability to deprioritize taxes in a Chapter 12. You can drop the IRS to the back of the line with the other unsecured creditors. And that's why Chapter 12 and being eligible for it is a big deal. And I was one that over the past couple of years that was involved in drafting of the change in the statute that resulted in an increase in the debt level for being able to file a Chapter 12. We got that up to $10 million now, and that had been in a little bit over $4 million. And that made Chapter 12 available for a lot more farmers and ranchers.
Okay. Well, it looks like we have run out of time for today. Everybody, I really wish we had the ability to clap on Zoom, Roger, but it is what it is. If you can hear us, we are all clapping. Thank you again for taking the time to join us today. We would have even taken.
Thanks, Jennifer. I'm glad you called me because I had it planned for tomorrow.
That's all right. Folks, we are going to go ahead and I think that about wraps it up for today's questions. Thank you all for joining us here over your noon session. And thank you again to our speakers, Roger McEowen and Logan Hoffman, for their insights. You can join us tomorrow at 9 a.m. for our final day of sessions. Tomorrow we will feature Jack Oates of Biozyme Nutrition, who's going to answer the question, is premium nutrition really worth it? And Kansas State's Sandy Johnson will share with us some practical considerations for use of sexed semen in beef operations. Now, the link to all of Friday's sessions can be found in your registration emails. If you liked this format, or if there's something different that we can do, just go ahead and let us know. As a reminder, all registered attendees will receive a survey in your email boxes, and we use those to craft next year's presentations, and so that we hit topics and times and schedules that work for you. So thank you for filling those out and helping us make a better experience for you in the future. So on behalf of all of us here at High Plains Journal, thanks for riding with us, and we will see you tomorrow at 9 a.m. for our next session of High Plains Journal's virtual Cattle U. Take care.
Dirt road in a gooseneck, saddle up with me. Dry land in God's country, crops far as I can see. Headlights on both ends.